So let's break it down in terms of the confidence that you have that these good conditions will stay, considering you're going to fund with cash that the buyout from BHP.
So it's 4 months since we announced the transaction back at the start of July. We've seen oil prices firm over that period of time. I think last time we spoke, we said that we're now seeing absolute stock levels globally and particularly in the United States down below the 5-year average levels. Things look well underpinned. We've had a strong quarter that's built off the back of the 6 previous quarters in terms of the plan we laid out. The finance is in a strong enough shape for us to actually say we had the optionality when we created the deal to use cash rather than shares. This is a much cleaner transaction now. We'll let our gearing drift up towards the top end of the band. It may go through that, and then we'll use the divestment proceeds to let gearing and debt come back down again at the end of next year.
So how sensitive is that with the gearing going up and then being able to come back down to that target range to the oil price? What oil price do you need for that scenario to play out?
What we've said is, look, I mean, any number of different scenarios could play out. $70 is a pretty good price right now, I think, in terms of the next six months as we look ahead. 6 to 9 months. If you look where stocks are, where demand is, which is staying robust, we're not seeing as much production come out of lower 48, but we expect that to ramp as the pipelines come in. So I think the price is pretty well underpinned around $70 right now. Longer term, we're still assuming that we can break even at $50 a barrel, and our break-even price goes down to $35 to $40 a barrel by 2021.
So in the short term, though, because there are still so many uncertainties for the oil market, what's the oil price that makes you have to rethink this plan? Is it 60?
No, well, look, first of all, the transaction was done as $55 a barrel WTI. We are significantly above that. And everything we see from the assets that we've looked at, and we're looking to close tomorrow, the transaction, would leave us in a more positive sense in terms of the assets that we're acquiring. But look, you know, gearing will flex with whatever the oil price is. And I think what we've demonstrated over the last 7 to 8 years is we've been able to deal with $67 billion of Macondo liabilities. We've been able to deal with an oil price that went from $110 down to $28. I am pretty confident we'll be able to deal with a $10.5 billion transaction on a gross basis, or net $5 billion after we sell off the assets that we talked about.
When you take a look at gearing sort of going above that target at 30%, what's the level that you wouldn't be comfortable with?
I think we have a huge amount of capacity within the existing gearing band. 20 to 30% is a large number. I think once you get up into the 35 to 40, you start to get uncomfortable. But the key here is either way, whether we fund through shares or fund through cash, the destination point on gearing, which is not an objective in itself, it will simply be an output of the fact of the growth plans we have. And you saw those growth plans come through in the third quarter with 7% underlying growth in production. As we stay on the trajectory going forward, the surplus free cash will naturally let gearing and net debt come down, because of course we're keeping the $15 to $17 billion capital frame within that tight range, which means we'll naturally have surplus cash that will allow debt to come down. And
a large part of that also is the divestments. Let's take that in 2 parts. So you have a $3 billion target this year, but you've only completed $400 million. Why? What happened?
We signaled at the start of the year, just like last year, it was a program that was always back-end loaded. Last year we had $4.5 billion of proceeds, with $3.5 billion coming in the final quarter. It will be the same this year, and we've signaled that we still anticipate we'll get over $3 billion of investments through this year, and then we'll start to look at, and we've started to lock and load the $5 to $6 billion program associated with the BHP acquisition.
So what's interesting, though, is that it feels like oil companies are getting punished if they wind up spending more. You can just look at Chesapeake today, for example, making an acquisition, that stock getting hit down by about 6% in the pre-market. So what gives you the confidence that the market's going to let these companies kind of come and buy your assets?
Well, so look, we're staying within our 15 to 17 frame. We haven't moved off that. We laid that out at the start of last year. The gross $10.5 billion investment in the BHP assets creates huge optionality for us. It's got a lot of synergies associated with it. We've now found the midstream we believe to be quite valuable within that portfolio.
Right.
And we'll manage that on a net basis to the tune of $5.5 billion. So I think our investors, all the feedback we've got is very positive in terms of that transaction.
Right, Brian, I meant for the companies that are going to be buying that $3 billion worth of assets that you need to sell. You seem confident you're going to be able to get it done in the next 2 months. And I'm saying, if the market's not rewarding companies for buying stuff, then why would you feel confident about you being able to sell what you need to?
On the $3 billion, I think we've got high confidence around that because it's not the sort of assets that you're talking about in terms of the ones that you mentioned around Chesapeake. In terms of the $5 to $6 billion program, I think we'll find that we already know we have multiple bidders on all of those assets, and we are looking in terms of breaking it up into a significant number of parcels that will allow us to get those transactions away. So we're pretty confident we'll have no issue with that particular sales package.
So for the $5 to $6 billion of divestments for the BHP acquisition there, would you be looking to then sell to different buyers or one huge lump sum buyer? What's that goal?
Now, I think lower 48, we've seen already through the BHP transaction. As I understand it, there were multiple people inside the data room, over 50 different companies, private equity. It will be a mix. I think the nature of the assets that we're looking to sell, particularly in the lower 48, there will be some natural buyers that will be the natural owners of those assets, and we'll have a whole suite of other options available to us. What we know is from the day we announced the BHP transaction, we got a lot of expressions of interest in the weeks and even in the weeks preceding the deal around some of the assets that may be coming on the market.
So how quickly can all this take place then, that $5 to $6 billion divestment?
Yeah, we'd expect to get the first tranche away next year. It will be a 2 to 3 year program. We've got the first series of assets locked and loaded and ready to go, and we'd expect to be making announcements around closed transactions next year.
How much pricing power do you think you have for the assets you're going to sell?
We'll see when we go to market. We'll find out when we get the first round of bids in. We have a team which is pretty hot. We've done something close to now $80 billion of transactions in the last 8 years. I think we have a very good M&A team. They are confident that there'll be sufficient expressions of interest. But as you'll know, Alex, if you have multiple bidders for an asset, that normally is a good position to be as a seller.
Fair point. When I was talking to some analysts after your quarter, because no doubt your quarter was super solid, they did say that what they want to see is accelerated divestments because of the spend for BHP assets, because of your buyback and dividend program. What's been the response of the time frame that you laid out? Do you get the sense that you need to do it faster?
Well, I think the fact that we've come out today and talked about BHP as being an all-cash transaction, that we're not going to dilute shareholders up front and then repurchase those shares back, and the commensurate friction cost has been received well by our investors. And in terms of the disposal program, gearing up at 30% is not something which gives us any concern right now as we go through the first and second quarter next year. And we're pretty confident we'll get the first tranche of disposals away in the back half of next year. So I don't think there'll be any issues around that. I
just want to wrap it up here talking about your refining unit, because that also has had a blowout quarter, in part because you were able to buy super cheap Canadian oil to refine it in your Whiting refinery in the U.S. Going forward, though, you're going to have some downtime at the refinery. Margins might not be as good. Are you going to be able to replicate that kind of killer number going forward?
Well, I think, look, we're on a steady path that we laid out to 2021 of $9 to $10 billion of free cash flow out of the downstream. We're up around $7 billion already on that target. I think there's a lot of optionality in the portfolio. Whiting will be out for another 5 weeks. We're halfway through a turnaround of its coker units, its crude units, and the sulfur units. So we'll go through that process. So therefore, we will have 5 weeks of revenue not there, but we have a huge amount of optionality and spread in our portfolio. And it's a turnaround that's been scheduled for quite some time now. So I think we have a lot of flexibility and optionality within the business.